I'm Gregory Page Romer. Some of you guys know me as Greg Romer. Some guys know Ken Page. So we're married. So I'm Gregory Page Romer now, my official investment advisor rep with Open Vistas Financial Solutions. Some of you guys know that. Some of you guys are my clients. Some of you guys are friends, family, all these things. So my thing here is to build your wealth, protect your assets, and enable your dreams. So my past history, some of you guys know me as a tech guy. My previous life, I was a tech person. Some of you guys know me as a football player or a basketball player or all those things. Some of you know me as a Medicare. I do Medicare also. Some of you know me as a Medicare person. So I do all these things. So I've been doing this for years, and I was a tech guy. I became a day trader for years, which I liked, but I wasn't really helping people a lot. So I wanted to become a financial advisor to help people. So I expanded my horizons and hopefully now helping people. Okay, so so my aim is to enable your dreams. That's kind of what I do here. My professional life's work is to empower people around their finances. Okay, so I'm here to help you guys understand what happened in 2022, but also look at what is potentially going to happen in 2023, right? Nobody knows for sure, but we'll look at some things. Have any questions, you can do them whenever, but you may want to know how it's going to affect your personal financial picture. I meet with people, just give me a call afterwards, let me know, and we'll spend a lot of time together, free of charge, go through your finances, do a fact finder, hopefully do analysis with my team and find some solutions and work it through with you.
You want to discuss why last year was such a bad year before you discuss what's going to happen next year, or no?
Yes, definitely. We're starting with last year.
Okay.
Okay, so here's our agenda. How did stocks perform in 2022? What drove the market performance? Where are we now? And what do the major financial firms forecast for 2023? They did, as you'll see, they didn't do very well in 2022. Okay, so first question. Okay, so how did they perform in 2022? Okay, so I got a question for you guys. Let me see if I can actually do this. So how did the S&P 500 perform in 2022? It lost, obviously. So did it lose 8.8, 19.4, 21.6, or 33.1? Let me see if it actually watch this. Ooh.
Oh, wow.
Get an actual poll. Is it working?
Yeah.
It's an anonymous poll, so don't worry. It's anonymous. Nobody's going to see what you guys said. Are you guys seeing the live updates?
No, I'm not.
No.
Okay.
No, but we got a message saying thanks for taking the poll.
Oh, okay. So I got 11 of 15 responded. So I'm going to say what it shows you. I'm not sure it's going to show up. Hopefully it's going to show up for everybody, but let me just, oh, wait, I got 12 now. Okay. So 3 people, well, it's pretty even here. 25%, 3 people said negative 8.8. 3 people said negative 19.4. 5 people said negative 21.6, and 1 person said negative 33.1. So, oh, here, share results. Yay. You guys see it?
Yeah. Yes.
Okay, that's what we guessed. I will now reveal the truth.
Do we get a prize?
I can tell you 3 people got it right. Okay, ready? This was a trick question because every one of these answers is correct. So the Dow Jones lost 8.8, the S&P 500 lost 19.4, the Russell 2000 lost 21.6, and the NASDAQ lost 33.1. So every one of these numbers you probably heard in the press somewhere because they're all valid numbers. But I asked you the S&P 500, okay? So I don't know if you guys know this, but the Dow Jones is only 30 big companies. So this one, it used to be the big index, but it's not used as much anymore. The S&P 500 is the top 500 companies. So that one is really what's used now for the index. The Russell 2000 is the small cap guys. So small cap ones were down 21%. And the NASDAQ, the big thing of NASDAQ is tech, right? So tech was down 33%. So if you were going gangbusters, the NASDAQ was killing it the last few years before 2022, made a lot of money. Well, it died. one third down in 2022.
Wow.
So you got to be. Is there a question?
No. What with the new chip thing? What does that fall under?
The new chip.
The new chip deal. So we're going to be making our own chips. What does that fall under? Is that
Oh.
NASDAQ? Is that Russell? Is that Standard & Poor's?
That'd be the NASDAQ. But the top 100 NASDAQ companies, like Apple and Amazon and all those guys, are also in the S&P 500. Does that make sense? They're not mutually exclusive.
Right.
So it kind of affects both. So tech is heavy, the Russell 2000 is small companies, but other than that, and the Dow Jones is a weird one because it's price weighted. So a pricier stock is going to have a bigger impact. And they've changed the formula so much over the years because there's no original Dow 30 in the Dow anymore because they've all gone out of business or gotten smaller. So they do this really weird formula. So it's like really crazy. Okay. So let me, thank you for your participation in the little quiz there. Okay. So this is what people guessed was going to happen. So at the beginning of 2022, they thought the S&P 500, Morgan Stanley thought it was going to be 4,400. UBS thought it was going to be 4,850. And by the way, I used to work at UBS. I didn't talk about this. In my previous days as a back office tech guy, I worked at UBS, I worked at S&P, I worked at the Fed, I worked at a lot of these places. But as you can see, the 4,400, 4,850, the lowest here was, I guess, Morgan Stanley. They had the lowest one. Their average was 4,867, but it ended up at 3,839. So they were all way off. Right?
What does that mean? Like 4,400? What does that mean?
Oh, they thought when December 31st, when the market closed, December 31st on 2022, the S&P would be at 4,400.
Okay.
It ended up at 3,839. So they were all wrong. They all way overguessed, especially Wells Fargo, right? They were the highest one there because everything was going gangbusters, right? So they just assumed to go gangbusters. So what happened? Well, let me get the next slide, but okay, yeah, let me just get back here. So things happened, right? So what are the two big things that happened in 2022 that nobody was expecting?
Pandemic.
The pandemic was kind of getting better at that point, right? So the two big things were Russia,
Ukraine.
exactly, Russia attacking Ukraine,
Mm.
and the Fed going crazy with interest rate hikes.
Right. Because of energy, yes.
So those were two things that were not expected, and they had major impact.
So it's all Putin's fault.
Exactly. Well, I mean, people like the markets don't like things changing, right? They don't like unexpected things to happen. So they didn't expect that to happen. But what also happened with that is Ukraine is the breadbasket for the world, right? A ton of food comes out of the Ukraine.
Yeah.
Well, when they're at war, that's not happening. Like I said, I used to be a day trader, so I do the futures trading, and wheat is one of the big futures that gets traded. It went crazy high, as you would imagine, because nobody expected that to happen, right? So a lot less supply, the standard thing, right? Everything's supply and demand, a lot less supply, so prices shot up crazy. And Russia is a big oil exporter, right? Not so much for the US, but it's a big oil exporter. So food prices shot up and gas prices shot up because of oil. So those are two big things that happened. Okay. So we drove the prices. Okay. This is just kind of a chart showing you, what happens with the S&P 500, right? The CPI is the consumer price index. That's what people pay, right? For everything. It's, food, gas, transportation, housing, all these things. So the CPI is education, recreation, medical costs. So, that starts raising up, people have less money, right? The gross domestic product was annually 6.9, then Russia invades Ukraine, interest rates start to hike. Interesting, right? When interest rates start to hike, people like that, right? Because they're trying to slow down the inflation. We'll get into the Fed a little bit too, what happens with the Fed. Well, I guess we should discuss now. The Fed. So I used to work at the Fed. So the Fed is responsible. I don't know if people know this. The Fed is responsible for monetary policy, right? So they're responsible for maximizing employment and also price stability, inflation, right? That's the Fed's main job. They got to keep inflation down. Their stated goal for inflation is 2%, or at least it has been that way for many years. They didn't want inflation going over 2%, which hasn't been difficult for many years until last year. So they also, do some other things, financial system stability and all that kind of stuff. Make sure that the banks don't go out of business, that kind of stuff. But, the main thing is the monetary policy. Their Federal Open Market Committee. That's the one that raises the interest rates. They raise the short-term interest rates. So inflation's coming in, it's coming in hot. They try to tighten the monetary supply, so it comes down a little bit more, right? So they raise interest rates. They raise interest rates so people don't borrow money. So it kind of slows things down and things don't go so crazy. So people like sometimes when they raise interest rates because they think that the Fed's going to keep things under control. Doesn't always work because you see they did the first hike, then they hiked it again. Inflation's going higher, so they hike it again. They hiked it again. They hiked it many times. I think they went up 4%, I think, or something. They went up a lot under the whole year. They kept raising the rates, and they're still raising the rates, right? People think the market started to do a little bit better in the fourth quarter because they thought the Fed was going to stop raising rates. And, the numbers didn't come in so well, so they came back to raising rates. And if you notice, so the fourth quarter, beginning of this year, the market was doing better. Actually, it's another important thing. People think the Fed, I shouldn't say cares about the market, but the Fed's primary thing is not the stock market, right? So people say, oh, they're not going to raise it because of the stock market. That's not really, I'm sure they consider it in there, but it's not really a big factor for them. They're more concerned with monetary policy. So they do monetary policy. There's also fiscal policy, right? So there's always this thing like the president and all that kind of stuff doing the economy. It's more the Fed, right? It's the Fed's responsibility, the economy. The president, all that kind of stuff is more fiscal policy. The fiscal policy is spending money, right? Budgets, how much each department gets, that kind of stuff. That's fiscal policy. It has some impact, obviously, if you're spending way too much money. So it does have impact on the economy. But, it's really the Fed's responsibility to do all that stuff. Okay. A lot of stuff on this chart here. Any questions? Or I don't want to, drag this on too long, but this is what happened last year. Okay. So also for company, a big thing for stock prices is what happens with the companies, right? So 2020, things were bad, right? The COVID hits, everything was going bad. Supply chain issues. Companies at the first quarter of 20, they lost their revenue growth, didn't grow and went down, right? The companies lost 15%. Second quarter, they lost 31%. The third quarter, so they had a rough year in 2020. So 2021, they had a great year because 2020 was so bad, when you compare it from the previous year, it was kind of easy, right? They went up 52%, they went up 91% because it was so far down. It was easy to go up, right? Because the supply chain was doing better, everything was starting to do better. Stimulus was going through, so people were spending money. So, but then 2022 came in, and same thing. Since 2021 was so good, when you compare 2022 earnings against 2021, they couldn't keep up because they did so great in 2021. So it kind of makes sense, right? It was really bad, so it was really good. So now it's not so good because now it's starting to even out again. But this factors in for, stock prices, right? If your earnings aren't as good, your stock price is going to go down. Okay, so the whole economy. These are just different things of looking at the economy in many different ways. So gross domestic product. That's everything that's made. The value of everything made in the country is the gross domestic product. So 2022, it was down. Again, because they did so well the previous year. The Fed actually, it does these things, it kind of always redoes. They look back a quarter later and they kind of readjust it. But so basically first and second quarter, it went down. There's always talk of recession. Everybody's worried about recession last year, right? That was the big word, recession. One of the definitions of recession is 2 down quarters in a row on the GDP. So in theory, we hit a recession last year because of these 2 numbers. That meant a recession. But it's like there's other things too, like a lot of employment was high, all those things were happening. So they decided it wasn't really a recession. There's talk of recession this year now. This thing that's called the Fed is called the soft landing, where they're lowering the rates, but not too much, because then it could cause a recession. So they're right now thinking there may not be a recession this year, but it keeps changing as the numbers happen. Then third quarter, actually, GDP went up. And the fourth quarter, I didn't actually, I probably should look at this. This was done the end of the fourth quarter, so that number wasn't in yet. I should have looked this up. I don't know if that number actually officially came in or not. It's already February, it's almost March. This number should have come in. So I don't know where that number is, sorry about that. The labor market was strong, right? We had a strong labor market last year. Inflation, remember the Fed wants inflation at 2% or less. It went up to 8.5, it was up to 9.1 in the second quarter. That's really high, but if you guys remember, what the 70s was up to 17% or some crazy number back in the 70s. So it shot up, it came back down, and I think the last reading in January was 6.4%. So it's definitely coming back down, which is a good thing. Consumer sentiment is, how strong the consumer feels about things. It hasn't really been that bad because people are spending money, I guess, because they're getting stimulus money and all those things, right? So they're still spending money last year. I think this consumer sentiment this month is up to 64 or something. It's gone up. So consumer sentiment is going back up. And then housing, this is the sentiment for home builders. So in the first quarter, they were strong, but they're going really down. So the home builders are not looking happy right now. They don't think housing, because interest rates are so high, right? So therefore mortgages are high. So yeah, housing looks a little worrisome right now. Okay. Okay, so that was last year. So where are we now? Okay, there's another quiz for you guys. There is no correct answer for this one. So how comfortable are you with investing in the market right now? Not at all. Like, I'm pulling my money out. I don't want to do anything with this market right now. Keeping your current investments as they are, white knuckling it, like, cautiously interested, like, okay, market seems to be picking up, so maybe I'll jump in. Or enthusiastic. Okay, the market crashed. I'm ready to throw all my money in. Let's do this poll. Okay, launch this poll. Again, there is no right answer for this one because this is just how you feel. Okay, I think we had 12 last, that's 80%. I didn't put in, so I guess, okay. Okay, I'm gonna end the poll. Sharing. Okay. So one person says, I don't like it at all. 7 people kind of like, white knuckling it. I'll just keep what I got. I'm not putting anything else in. I just, can hopefully make it through. 4 people are okay. Yeah, maybe I'll start putting some money back in. And somebody's gung ho. I like that. But let's talk about what's going to happen before you start putting your money in. Okay. This is the indicators back in November 2020. So what was happening in November 2020? What was one big thing? What happened in November 2020?
Election.
Exactly. There's a big election coming. And also, COVID was still kind of here, things were, so the monetary policy, so these are just a bunch of indicators for the economy, right? There's monetary policy. This just showing, green is good, right? So the economic outlook was kind of in the middle. The yield curve, that's the bond yields, the consumer sentiment, personal income and wages was down because people lost jobs back then, all the other kind of stuff, right? Mortgages, interest rates are still cheap. Mortgages were cheap then. The labor market was having some issues. Consumer spending is a big thing for the economy. If the consumer, like 70% of the economy is consumer spending. So if consumers don't spend, the economy's in bad shape. That's why they did the stimulus, right? They want to give people money because you give people money, they'll spend it, people be employed, things, it keeps the whole economy going. So that was the whole purpose of that. Interest rates still weren't going up yet. Fiscal policy was okay with the government. Business spending was getting a little bit worried. The leading indicators, we'll get into those, but there's leading and lagging indicators. Leading indicators is how the economy is going to go. Lagging is how it happened in the past. Corporate profit was still there. International and economic, same thing. Political environment, because election time. Inflation was still down. They're starting to raise rates of credit, wasn't as much available. Energy costs were starting to go up a little bit. Equity markets where the valuation was down because I guess they were so expensive, and geopolitical risk. Okay, so that was 2020. Now we're going to show you the next 2 years. So it's kind of like, just look at the general picture. That's the economy, right? Some greens, a lot of yellows, a few reds. It's kind of mixed, right? Okay, what happened the next year? Gung-ho. Everything's green, no reds, a few little yellows, right? But everything's like gung-ho in November of 2021. Then what happened? 2022 hit us. Ooh.
Oh, jeez.
Yes. So last one, December 2022. So 2 months ago. What shape are we in? Ouch, right? Monetary policy, right? The Fed's raising rates all over the place. The economic.
Hey, Greg,
Yes.
do they do this over like a 10-year period or something compared to just like 1 year compared to the last year? Because it seems kind of weird to compare 1 year to the last year because it's kind of.
Yes, this actually is done every month. So this is a 3 to 6 month time horizon. This is done every month for at least 10 years, I think. So you can compare it. Yeah,
Right, because what you're showing now, the 22 is compared to 21, right?
Yeah. This is December 22 versus December of 21.
Right.
No, sorry, November of they did. So so it's 1 year later. But it was
how does it compare to like over an average of the last 10 years? It would be totally different. Not that it matters. I'm just, go ahead. You can continue. I'm sorry.
No, I know what you're asking. It's because it just fluctuates. And this one doesn't show it as much. The other one that normally has it actually shows you the previous month. I'm not, for some reason, when they put it in this particular format, they used to have like a gray one showing you where it was the previous month, so you can see what changed. In that one. I don't know why they don't have it here.
Okay, don't worry about it. Thank you.
Good question though. Oh, okay. I want to get into a little bit of politics here. Don't talk politics, I know, but people, I would say it's I guess confirmation bias, right? People have confirmation bias. Just being human, that's just the way it is. But really in politics, right? So they think, you know, as I said before, the Fed is kind of responsible for the, you know, monetary policy. It does all this stuff, but people think it's, you know, if my guy's in, he's doing great. If your guy's in, he's doing terrible. So just out of curiosity, just to show you, you know, when people ask this question, you know, what's happening, this will actually show you. This was from 1945 to 2022. Okay, this is going to show you here if there's a Republican, you know, first one's president, next one is Senate, and the third one is the House. So for 10 years, there's a Republican president, Republican Senate, and Democratic House. That showed up to be the best for returns of 19.7%. The next was 26 years of just Republican Senate was 16.7. Then you have Democratic president, Democratic Senate, Republican House, it was 16. So just kind of showing you all the differences, right? I guess watch out when it's a Republican president, Democrat Senate, Republican House. There's only 2 years, so 2 years is a very small thing. So actually none of these was 0. So it's just showing you it doesn't really matter. You know, it doesn't really the Congress doesn't really matter as much as you think. You know, the president, Congress, all kind of stuff. It's really more the Fed. And the Fed is done, like the president appoints the people, but it's not like when the president comes in, he reappoints the whole board of the Fed, right? That doesn't work that way. There's rolling years, not even the, you know, the chairman. It's like, it's rolling over different years. So they sometimes keep them on, sometimes they change them, but they're separate. They did that with the Fed to keep it apolitical because they're responsible for the monetary policy. They didn't want it, new president, new policy, right? So, so just interesting to show. And if you really want to know what happens for specific presidents, this is what you have. So Roosevelt, Truman, Eisenhower, just shows you the different people, the different presidents, and what happened. Again, it's more the Fed than the president, but here's the gory details. And remember, everything else happens too, right? This, you know, Clinton will do something, and Bush got hit by that. Bush did something, and Obama, you know, won because of that. So, you know, that all factors into. So I just want to say that. Try to stay out of politics with the economy is the bottom line there.
What about the the debt that's created by different?
Yeah, I don't have that one in here, but it's going crazy. It's crazy, crazy, crazy.
So doesn't that?
So that will affect. Yeah. Yeah. What's that?
Wouldn't that affect?
Yeah, but it's very cumulative. Yeah, so I don't think I have that slide. It's very, you know, it just keeps, every president, it just keeps going up and up and up and up and up. I think in Clinton years, I think it went down a little bit in the Clinton years.
Yeah, he balanced the budget, and we had a profit, whatever, not a profit, no more deficit. We were in the positive.
Yeah, so, but you know, that was also the Republican Congress also was pushing for that too. So you got to be careful. You know, they all have pros and cons. You know, but yeah, that is a good point. So how much money? You know, I read that the other day. It's crazy. Like what % of our budget is just going to pay off the debt?
Right.
And it's high. Yeah. So I don't actually have that. Have that one in here. Okay. Okay. So I just want to throw it in there. Try to stay away from politics. Okay. So these are recessions again. There was not really one in 2022, even though some people say it was, because we had those 2 down quarters, which is a main indicator of a recession. But as you can see, when you hit, when you hit the recession, when you come out of the recession, zoom, right? Come out of the recession, zoom. This one, it's called a V. It went down and up so fast. Nobody expected it to really, well, look, it was 2 months. This one here was, 8 months. This one here was 2 years, right? Or a year and a half, whatever. So this one here was 2 months and it shot out of it. So, but that's because stimulus, this was COVID, right? COVID hit, so. Let me just see, hold on a second here. Hold on a second. Okay, so there is talk of coming into recession this year. Like I said, it was supposed to be sooner, then it became later. Now it's maybe not at all. Yellen, she was the Fed person. Now she's the economic person for Biden. She says she sees a soft landing, which means no recession. But she's in the administration too, so she's going to say things like that. So nobody really knows for sure if there's going to be a recession. People think there's going to be one, but if it happens, it should be, we're talking like third or fourth quarter now, if it happens. Okay, so for this year, what are the headwinds, right? So what's going to cause problems with the stock market? So first is inflation, right? Inflation is still high. The Fed wants it down to be 2%. I don't know if that's going to happen right now, but it is definitely going down, right? There's also the rising yields. So the bond, I don't know if you guys know bonds. The way bonds work is as yields go up higher, as interest rates go up higher, yields go higher, bonds go down. Because think of it, if you bought a $1,000 bond with 5% interest rate, if interest rates go up to 6%, who wants to buy your bond at 5%, right? I don't want your bond at 5% unless I'll give you $800 versus $1,000. So it hurts bonds. We'll get into a second. We'll show you what happens with stock market and bonds in a second. The Fed policy uncertainty, because the inflation, they don't know what's going on. The last meeting they had, they talked about raising the rates. They were talking originally like a month or two ago about maybe tailing off, raising the rates, but now the last meeting they all wanted to raise it, quarter basis point. Some of them wanted 50%, so it went up. They're still concerned it's still going to go higher. So the Fed policy uncertainty, who knows what the Fed's going to do? There's a thing in investing called don't fight the Fed, right? If the Fed's going to raise rates, it's going to affect us. So don't try and guess what the Fed's going to do, because if you're on the wrong side, you find out easily. Again, as a day trader, when they had the FOMC meetings, they would at 2:30 announce the results. The market would fly. It's crazy watching the market when they do the announcement. And then half hour later, when they start talking, the market flies again because you assume something at 2:30, but when they talk about it later, it changed all again. So, so basically, don't fight the Fed, right? If it's going to raise the rates, you got to deal with it. Again, recession is a possibility. Again, they're thinking maybe not as much. Corporate earnings, as you saw, the corporate earnings are down only because last year was so high. But consumers have been spending, so it keeps the corporate earnings going. But that makes a big difference on their stock price. And geopolitical tensions, obviously, Russia, Ukraine, who knows what's going on there, right? That's going to still happen. I don't think people. What's that?
I said China also.
Yeah, exactly. And then China with Taiwan, right? A lot of stuff's happening over there. So a lot of stuff, is some headwinds. Okay. But let's look at tailwinds, the good stuff, right? inflation is coming down. It's been coming down for a while. I think it drops almost every month, sometimes a tiny bit, but a more dovish Fed. So the Fed is like trailing off on doing their raising. Falling US dollar. The US dollar went really high. So that affects companies' earnings outside of the country because buying stuff outside the country. And again, interest rates, if the yield starts coming down, it's going to help everything. Seasonal effects, just buying during different seasons. And China is finally out of the lockdown for now. Who knows? They may go back in, but they're out of lockdown, so that should open up a lot more supply, right? If they're locked down, they can't make products for the rest of the world like they've been doing. So we'll have more supplies coming in. That really affects things too, right? Supply and demand. Okay. So PE, price to earnings ratio. That's like, is a stock overvalued or undervalued, right? So the 25-year average is 16.84, right? That's normal PE. Growth stocks like Amazon, ones that make tech stocks make a lot of money. They have different PE ratios. This is just normal companies, not crazy companies. So it just kind of shows you, things get expensive. They're above one standard deviation, they get more expensive. So as you noticed, stocks before 21 were getting really high, right? The prices were, the stock market was going crazy. Then it crashed. So it hit about average. It was going down. It popped up a little bit. Now it's going down again. So right now the stocks are a little underpriced to norms, just, in general. Okay, so let's talk about 2023. Okay, so excess savings. So there's income, then it's outlays, fiscal support. This is showing you, in 2020, we were giving a lot of stimulus, right? A lot of things are happening. And now it's kind of that's all trailing off, right? So it's, people's things going down. So savings were going high. People were saving a lot of money because they're getting stimulus and all those things, right? So we're saving their money. But now, bless you.
They were going out because of COVID.
Exactly, they weren't going out. They were saving. They're getting stimulus checks. A lot of people were working from home, getting paid, not going out, getting stimulus checks. So they were saving money. But now, they're starting to spend money. They're going out again, doing things like that. So there's no longer excess savings. Now they're spending more than they're saving. That's just kind of showing you two different charts. So savings are going down. People are spending. Okay. Quarterly bottom. Okay, earnings per share. So again, it was showing what's going on here with the companies. So it was going up, kind of trailed off a little bit. 2022. These are estimates. Again, I probably could have gotten. I don't know. I probably should have updated this. Sorry, this was done in November. I probably could have gotten the real number here. So expect earnings per share to go up, right? Which is good for stocks, right? You want earnings per share to go up. So it's kind of going on an upward trend here. They're expecting this is up to 2023, remember? So this is really looking, it's kind of flat here, but it starts going up for 2023. So hopefully by year end we'll be higher. Then again, that's good for stocks, right? Earnings per share, you want to be higher. Okay, interest rates. Again, this is in points what they expect the Fed to be. So the feeling here was it's a 50% chance to be between 4.75 and 5.0 by June of 2023. This was back in December. This probably has gone up a little bit higher because they're raising rates more than I thought. So I would imagine that it's probably more. This is probably higher now. So they think the rates are still going to go up for a while since this chart was made. So I should have updated this chart. But, they're just showing you where they think the target rate is going to be with the Fed. Okay, so the real GDP takes inflation into account. Okay, so this is what they feel is going to be. So this was what they had this is November. So this is what they, the previous, what they thought the GDP was going to be. And this, so it was 1.2, went down to 1. It was 1.1 down to 0.2, or so it really dropped, right, in their estimates. So they really dropped what they thought the real GDP was going to be to the new ones. Unemployment has been, really low, right? Everybody's getting jobs these days. I think I read somewhere there's 2 jobs for every person trying to look for a job right now. So unemployment, it's going to go up a smidge, but these are low rates, right? These are all low. So this is a good thing, right? People are still getting jobs. That's a good thing. If people weren't getting jobs, it really slows down the economy. So that would be a bad thing. And again, this is just the labor market, right? So the JOLTS report, right? It's just showing you job openings. Again, if you notice job openings, because everything opened up, so it shot up. And this is, we have the what's it called, the great people leaving work. There's a name for this thing. The they're quiet quitting and all those things.
People leaving the workforce, you mean?
Yeah, everybody's leaving the workforce, right?
Great resignation.
Thank you. The Great Resignation. That's a great recession. The Great Resignation is happening, right? So there's a lot more jobs out there right now happening. So, so jobs are plentiful. That's a good thing, right? There's starting to be some layoffs in tech. I don't know if you guys have been hearing that, right? Some of the tech companies are starting to lay off, but that's mostly because they overhired during the pandemic, right? Because tech really took off because people worked from home, right? Zoom, we're using Zoom. Zoom went crazy in price, right? Because they needed, everybody was Zooming from home, right? So the tech companies really hired a lot, but now things are starting to get better. People going back to work. So the tech people are starting to lay off people. I don't think that's a huge thing. I think that's just kind of, the way life is happening right now. Okay. Yeah, we're running out of time here. So, okay. This is the poll again. This one is for completely your guess. Nobody knows, right? How do you think the S&P will perform in 2023? Will it lose 10%, stay even, gain 5%, or gain 10%? I guess this could be 10% or more, lose 10% or more, or gain 10% or more. But this is where the S&P would. These are the numbers for the S&P, right? It started the year 38, 39. So let me put on the poll for you guys. Again, this is completely your opinion. It doesn't mean anything in reality. Just to get your feeling of where you think the market will be.
Please say D.
I can't make things happen. You guys can't make things happen. So, any more guesses? All right, it's going. They're coming in. Good. Okay, they're coming in. Okay, let me end the poll here. This is what we think in our very unscientific poll. This is good. 2 people think it's not going to go anywhere, but 4 think it's going up 5, 4 think it's going up 10.
The glass is half full.
Exactly. Nobody thinks it's going down. Okay.
What's the answer?
Well, I'll show you what the experts are thinking. This is what they think. Okay. Here, let me go back with the so
Flat.
38, 39 is going nowhere, right? So 38, 39 is our basis.
Flat.
So, they think it's not going anywhere.
Yep.
Right?
Mhm.
I guess here, UBS has the, I actually work for UBS. UBS has the highest. They're thinking it's not really going too much for the S&P 500 next year. But again, this was back in on December 31st. Things change over time, right? Just to quickly give you an idea of what happened with the market last year. So this is showing the S&P. So it drops 14.3% on average If you look at these are the negative numbers, right? So in 1980, it was down 17% at one point. It ended up being up 26%, but it was down. So these are how much it went down at some point during the year. So, but if you look last year, 2022 was pretty big hit, right? That's the third highest hit since 1980, right? This was the worst, second worst, and so 22 was the third worst year for the S&P 500 since 1980. It was down 25% at one point. Okay. This is the killer. Bonds. Like bonds hardly ever go down, right? Here's -3, -1, -2, -2,
Wow.
-13. Right, that was a huge. So people go to bonds to be safe. Last year, that was not the way to be safe. And a lot of times people get like a 60-40 portfolio, 60% equities, 40% bonds. It's a standard mix for, for safety. If you look at all the years, if you notice one thing, they've never both been negative until this year. It's the first time ever they've both been negative. So there's nowhere to run, nowhere to hide last year. So if you went in this 60-40, safer conservative portfolio, you're still down 20%. So should you be in the market or out of the market? This shows you here since 1937, okay? 20 times, so here the average annual return from 37 to 21 is 10.7% being in the market. There was 20 negative years. Of those 20 negative years, you were down 12%. And this actually shows you which year, how much you're down, right? So 5 years, it was down less than 6%. 10 years, it was down 6 to 12, right? 3 years, it was down 24% or more. On the positive side, 65 times. So 20 negative years, 65 positive years. You average on positive years 19.7%. And again, it's less than 6% for 10 years. 21 years, the biggest one is up 24%, more than 24%. But this is an interesting chart right here. Trying to time the market. Okay. Oh, sorry, I guess I lost the thing. If you put, whatever money in, $10,000 in on January 1st, it's $10,000 you put in on January 1st, 2002, stayed fully invested, you'd have this much money, right? If you miss the top 10 days, timing it, I'm going to pull it out because the market's going to go down, I'll go back in. If you miss the top 10 days, your 61,000 will be down to 28,000, less than half because of 10 days not in the market. Down 16, missing 20 days, 30 days, 50. If you miss the top 100 days, your 61,000 would only be worth $1,000. If you put in, you'd be down, right? So timing the market is tough. So be careful of pulling the money out and waiting for the market to go back up. Okay. So, for clients of mine, if you want to be a client, if you're a client, keep us informed what you're doing, tell us of your concerns, and make sure your documents are up to date. My job is to keep you informed and manage your investments and keep abreast of economic factors. Okay, we are, sorry, only 5 minutes left. Okay, any questions? That was a lot of stuff. Sorry, it's a lot of stuff.
I have a question.
Go on.
When the stock goes down, excuse me, and we lose money, quote unquote,
right?
Where does that money go?
It goes nowhere. It's on paper. If you don't take it out, that's one important thing. If the stock is down and you cash it out, it's just a paper loss.
Okay.
That makes sense? It's not really a loss. It just looks that way on paper. But if you cash it out, then you lose the money.
Right.
So, but also be careful. The problem with people investing is they let their losers run and they pull out of their winners when they win. So you're guaranteeing yourself a loss there. If something's up a little bit, like, oh, I want to win, I want to take my gain, and they take their money out with a little gain, and that thing just keeps going up and up and up. They don't lose all that gain. You know, they don't lose it, but you know, they don't get it. They lose opportunity for that gain. But if a stock goes down, they think, oh, I'll just wait until it goes back up again. Then it goes down more, and it goes down more, and goes down more. So they basically hold the losers and sell the winners. So you know, it's a very common emotional thing to do. So you got to be careful with stocks doing that. When you buy a stock, you have to go in with, you know, your entry price, but also a target and a stop out. If it, you know, when it goes up to this price, I'm out. I made the money I needed to make. But it's a thought out answer. It's not like, oh, I feel like I want to pull out now. You go in knowing where you want to get out, and you have your stop. Like as soon as it hits this point, I'm out. I lost money, but I don't want to lose more.
Mhm.
That way, you get out of your losers and you keep your winners.
Okay.
But it's hard to do. But that's that's the best way to invest. You should never go in without knowing where you're getting out. And you can even put in, you know, you can put in orders to get out at a target price. Okay. Any other questions?
Comment.
Go ahead.
It's pretty scary times right now.
But I can tell you, there are products out there that can guarantee you no losses, market gains. It's like crazy products out there that can do these things, but you got to lock up your money. There's always a but. You can't like have everything with no downside, right? There's always a possible downside. But there are, you know, there's even products, there's crazy products out there. There's products that, you know, there's like buffer products. You can say like over 6 years, I'll take a buffer of, you know, 20%. So the company you buy from will take the first 20% loss. And then anything above that you take. But I think over 6 years, that's never happened. Over any rolling 6-year period, there's never been a 20% down. There's been in a year, there's been 20% down, but over a 6-year period, right? 72 months, whatever it is. There's never been a time that's been down from that point to that point more than 14.5 or 15%. But you can buy a product that says, if after 6 years, you get it on, you know, let's say February 28th, 2023. On February 28th, 2029, whatever it is at that point, if the market's down more than 20%, say it's down 21%, you lose 1%. They take the 20% hit. You lose 1%. Okay, but on the top end, it's like 100%. You can make 100%. So you know, average out over time. But so you can double your money, but you can't lose more than, well, I shouldn't say you can't. They take the first 20% loss. But they even have products that do that, but then say it goes down 15%. After 6 years, it's down 15%. Instead of you losing 15, you know, sorry, the one I just explained before that, if it's down less than 20%, you're even. You break even. You don't lose a penny. If it's down 21%, you lose 1%. If it's down 19%, you lose 0%. But then you have products now, if it's down, same thing, if it's down 21%, you lose 1%. If it's down 19%, they actually give you 19%. They flip it. They actually give you the loss. And they still have the 100% cap top. So there's lots of products out there to do all these, they're crazy stuff. But it's only right for certain people, right? You can only put so much money in it. You know, there's all these, you know, rules around it. But you know, there's lots of products out there to make it not so scary for people that don't want to lose money. But you know, some people are like, market goes up, right? I showed you that chart, right, of the market going up. So the market goes up. People said, okay, I'll lose a little bit now, but I'll get it back soon, right? It'll come back next year. So they'd rather have all in, go for it. It all depends on your risk, right? Everybody has their own risk. And normally, the more risk you take, the more reward you should be able to get. no guarantees, but but they have products to help people that don't want to take that risk, because it is scary out there now. The market's been doing so well for so long, people forget, if they even have one little bad year, it turned around the next year. So like, woohoo. That makes sense? Let me just
Yes,
actually get to my letter. So, yeah, so here, you can book a free consultation with me. I can review your goals, needs, and dreams, understand your overall financial insurance situation, discover new ways to build your wealth and protect your assets, and build a plan for you. You can contact me, just let me know, send me a little chat or something saying, hey, I want to talk to you. You can call me, here, actually, let me do that. You can, right, you can go to my website, book an appointment there, email me, I'm on social media, my cell phone, text me. I'm easy to get. Okay, we're 2 minutes over, but are there any more questions?
this is really informative, George. Greg, I mean.
Only my mom can call me George, but I'm in trouble.
Any last piece of advice for us, Greg, or suggestions?
Any last piece? Well, I had some money out of the markets. I put it back in mid last year, so I kind of got in too early myself. I don't like being out of the market personally. I do like these buffered products. I do like these, annuity products. There's some fees. Sometimes there's fees. Sometimes there's not, depending which one you go with. For people that I own some myself, so I do like, some of the money being safe where you can't lose money, but I like other money in. I like the ones where it's kind of safe, but you can still make market-based returns. That's kind of, a good thing. Oh, I should, one last advice. Anybody at retirement age, this is very important, actually. Thank you for saying that, Ken. If inflation's bad, interest rates are up. But what's good about that is if you're retiring now, you can lock in rates now higher than you've been able to for a long time. So, that's actually a good thing. I don't know if it's good, but whenever there's a downside, there's a good side. There's a lot of products out there now that have been around forever, but haven't been used in forever because they were useless because you didn't get anything from them. They're back. They're coming on strong now because now they make sense. So, even fixed annuities, it's like a CD. You can get those, 4%, 5%. You can get those. Or before they were 1% or 2%. So that's one good thing. If you're, retirement age or retired, there's a possibility there. Okay.
Good stuff.
Anything else? I think. Okay. Any other questions?